Imagine that you are running a bank. Your job is to take deposits and lend. You make money as interest on loans given and keep a spread. That's how you make money. Now suppose that for every 100 rupees you receive, the government says keep 63 with us, leaving you with just 37 to actually make money. This wasn't a hypothetical nightmare. This was Indian banking in 1990. The system was paralyzed to the core, and to fix it, India did not need a politician. It needed its most trusted banker. In the last part, we talked about how an overnight heist by the Indira Gandhi government led to one of the biggest banking network expansions in modern economy. Now we continue from 1991. The balance of payments crisis and IMF rescue meant India could no longer work the old way. Liberalization was no longer merely an option. It was the absolute necessity. And banking could not be an exception. In fact, banking had to be at the core of the reforms. And to do this effectively, government brought back former RBI governor and the RRB architect Narasimham. The first Narasimham Committee of 1991 identified 4 key problems and prescribed drastic solutions that would change Indian banking. First, low credit. Banks had money, but they weren't lending. An SLR of 38.5% and CRR of 25% meant they could only lend 37% of the money that they had. His first step was to cut SLR to 25% over 5 years and CRR to 10% and eventually even lower. The second was the hidden bad book. For decades, banks would recognize profits on bad loans, even the ones that hadn't paid a dime in years. It was paper prosperity. Narasimham said, stop lying to yourself. Prudential norms were introduced for income recognition and asset classification, and this would go on to form the bedrock of modern Indian banking. Third, a fixed interest rate. In those days, government controlled everything, and everything included the interest rates that could be charged on loans. This changed in 91. Deregulation of interest rates meant banks priced all the risk and market determined the ideal interest rate on loans. And fourth, prolonged litigation. For bad loans, resolving litigation would take over a decade at best. This led to delays in recovery and consequently heightened bank stress. Separate debt recovery tribunals, DRTs, were set up for speedy disposal of cases and faster recovery of assets. Along with this, the committee also suggested a 4-tier structure to redefine the hierarchy of Indian banking. At the very top of this 4-tier structure were 3 or 4 large banks with the vision of a global presence, including the likes of SBI. The second tier was of 8 to 10 national banks, which would provide comprehensive domestic coverage. The third tier was of local area banks that would form an extensive regional network and solve for mass distribution. The bottom tier was of Narasimham's own brainchild, the rural banks or RRBs, which would provide for universal grassroots penetration. The committee also paved the way for private entry and led to the famous class of 93. While the government banks were grappling with unions and legacy tech, these new players, which included HDFC, ICICI, and UTI, which later became Axis Bank, built their empires on technology and service, thus changing the face of the Indian high street forever. These reforms, brought in by the first Narasimham Committee, saw rapid development and modernization of banking in the country over the coming years. But this was once again threatened by the Asian financial crisis of 1997, and hence Narasimham returned. While the first committee was about reforming the system, the second was about strengthening it. Their mandate was simple: bulletproof the financial architecture against future shocks. The second Narasimham Committee, formed in 1998, separated the strong banks and the weak banks and prescribed four key measures to strengthen the banking system. It said that while we have strong banks, we need to make them stronger by merging them. Essentially, a strong and a strong will merge together to form a global champion. This was the formula prescribed by Narasimham. Second was to merge developmental finance institutions into banks to create universal banking system. The DFIs were institutions that provided long-term project finance for infrastructure, power plants, etc. This prescription led to the mergers of ICICI with ICICI Bank and IDBI with IDBI Bank. Third, limit the weak banks to narrow banking, which means that till the time their books are cleaned and assets are stronger, they can only invest in government bonds. No lending was permitted. And the fourth one, higher capital standards. While the Basel norms suggested a CRAR of 8%, Narasimham said 9% because Indian banks and the economy was structurally riskier. Thus, the committee introduced a system of quarantine and shield. Keep the affected banks isolated till they are healthy and build stronger shields to protect everyone. By the early 2000s, the surgery seemed successful. We had global champions like SBI and ICICI. Capital standards were higher than Basel norms. The system looked bulletproof. Banking was reformed and strengthened. But in the shadows of this new universal banking boom, a new problem was brewing. It wasn't about government control anymore. It was about cronies and reckless optimism. The banks were about to write checks that they couldn't cash, leading to India's lost decade. How did the dream of 2000 turn into the nightmare of 2014? That is the story of the twin balance sheet. Coming up next, this is the India Brief.